Hey guys, Christopher Mullen here from the technicaltraders.com. I want to kind of recap the markets here from a long-term investor standpoint, because really, if you are 40 years or older, you've got a lot of money tied up in the stock markets, different assets. This is a life-changing opportunity to make sure you don't miss out on, and you don't get caught on the wrong side of what the market is going to do. So I want to cover the markets from a high level, where we are within a bull or bear market, and the ways that you can take advantage of this, or at least avoid them, so you don't give back 30, 50+% of your retirement capital or your investment in capital in the next few months, or potentially the next couple of years. So let's jump right into the charts here, and let me show you what we're looking at. So here we've got the SP 500. This is the daily chart on the right-hand side. Another big down day for stocks. SP 500 down 2.4% today. We zoom in, you can see here, it's starting to break down in a pretty big way. The NASDAQ down about 3%. You can see our 30-minute regular trading chart. We've got the bars are red, which means the market is in a short-term downtrend. Had an overbought pop on news when the Fed came out last week, and then it got sold into. And this is a really bad sign. We're starting to see huge panic selling, with our panic selling indicator spiking above 30 at one point intraday last week. And we are back up in the teens today. That's telling us that everyone is running for the door. They're all hitting the sell button, a market button, meaning they don't care what price they get for their stocks or commodities that they're holding. They just want out. And that is not a good sign when it reaches levels like this. That means there's actually mass psychology kind of shift. It's not just an oversold condition anymore that's going to be bought up. We might get a bounce, but we're actually seeing full-on herd mentality around the world, people liquidating and actually going from a bullish kind of point of view, slowly turning into a bearish point of view. Now, most traders and investors don't feel that way. Right now is the very early stages of what I think is a bear market that's about to start. And most of the selling right now, and that we've actually seen since about March of 2021 with growth stocks, it's the big institutions unloading, getting out of all of these trades, trying to unload, distribute shares before this big downtrend really starts. So let's take a look at this overall cycle here of the market. So I've got a couple different ways to look at the stock market. Let's zoom in on the economic performance first here. The blue cycle here is the stock market, and it tells you kind of what sectors or commodities do well. It's at different stages. Now, when the stock market is close to a top, we tend to see energy, precious metals, commodities in general do pretty well. That is what we have seen. I think we've seen the blow-off move in energy in most regard. Maybe natural gas could go a bit higher with what's going on in Russia, the UK. But we've also seen utilities become hit all-time highs. We're definitely seeing the late-stage sectors and commodities rally. That is not a good sign. And the stock market will top out before the economy does. And we can already see the economy, starting to slow down. Inflation has got everybody tightening up. And so we're definitely in this kind of late stage market. Now let's go and look up at the kind of psychology of the traders here. I think we saw in 2021, after COVID, we saw, I think, a euphoric phase. I mean, anyone who was partially interested in the stock market got into the stock market and tried to make a living from it. And it was a euphoric move. We saw sectors move hundreds of percentage points, and now they've kind of sold off. And now we're in this complacency stage, kind of right on this verge of anxiety, where a lot of people have been accumulating shares, buying up growth stocks as they, averaging down, thinking this market is going to rally. Problem is, we're starting to actually break to the downside to start a bear market. And this is when a lot of anxiety is going to kick in. People are going to realize they're on the wrong side. They levered up in the wrong stocks or assets, and they're going to lose potentially a ton of money if this market continues to decline. So we're in what I think is almost the anxiety phase starting to kick in. And this could last, 6-8 months. It could last 2 or 3 years of lower prices. It really depends on how it unwinds the stock market, the deleveraging takes place. So we were, when you look at it from a financial standpoint, we are way up here, this peak financial risk, putting any money in the stock market right now, even into real estate, buying companies, all those things, I think you're paying a premium. I don't think there's a lot of upside left versus how much downside remains in this market for a reevaluation event. So we got to be very aware of that. Now, if we were to go back to the market here, let's take a look at our technical investor. If you're an investor, you've got retirement capital, whether you manage on your own or you've got a financial advisor, this is critical for long-term growth. This was the 2000 market peak, the 2007 market peak. When we get into a bear market, you do not want to be holding stocks. And this time around, you do not want to be holding bonds either. Both are selling off in a big way. And it's a double-edged sword. What used to work isn't working anymore. 40 years of falling, rates. Now rates have bottomed. Now we're going to probably start to stabilize and move higher. Bonds are going to continue to be under pressure for a long time. So we've got this indicator tool. We've got our investor service, TTI, the technical investor. And, it kind of points to when you need, as a long-term investor, to say, hey, you know what? I'm going to move to cash. Sometimes cash is the best play. And you just sidestep this market. There's ways to take advantage of a bear market, which I won't go into the details right now. But if you can sidestep these bear markets and just hold on to all your wealth, let the market reset, buy back in at a much lower price when risk has been reduced, then you can, make a lot more money on the next leg higher versus this roller coaster ride. For all we know, when you get up to this high in 2000, it took 12 years for the markets to get back to that level of wealth. And if you're, 40, 50, 60 years of age, you do not want to wait a decade for that to happen. In fact, the NASDAQ, if you're in growth stocks like the NASDAQ, it took 18 years for the market to come back. You're going to be well on your ways to not needing the money anymore if you've got to wait 18 years to get your money back. And what the problem is, if it devalues, you're going to start burning and spending your money, your savings, at a devalued rate. And when it does come back, you're going to have way less than what you really were hoping for originally. So this is really critical to sidestep this market. And a really good way to do this is we've got the technical investor service here. And I'll leave a link to this down below, but let's just zoom into the performance here so you can get an idea of how this unfolds. When you look at these lines here, so the green line is TTI, the gray line is the SP 500, and the black line is just the world stock market in general. So the key here with technical investor is when the stock market does start to roll over and we get into a technical downtrend, a bear market, as an investor standpoint, the market, you can sidestep it, let the market just collapse, and you can move to cash and go on and live your merry life. You can get back in when the next market happens. Again, you can move to cash during a bear market over here in 2008 and then get back in. And you can ride this market for most of the upside and reduce and eliminate a lot of that downside and stress. And it's really important. Now, this strategy doesn't use any leverage. So in the long run, if there isn't a bear market, eventually the stock market will catch up to this performance. But you outperform or match the stock market performance without the volatility, without the drawdowns. It makes a huge difference in your mindset, in your lifestyle, in your comfort, anxiety, all those things. So it is really critical just to use a service like this to step aside and go live your life and do something for the next several months or potentially a year or so, and wait, have all this money sitting on hand when you can buy all the stocks, the growth stocks you want later at a huge discount, when dividends are higher, all of those things. So that's the way I see this market. And I mean, this service is a very simple service to follow. It's super passive, very few trades. There's no leverage. It's only $249 a year. And you can, you just need to avoid one bear market. And you've probably saved tens, hundreds, or even millions of dollars going forward for retirement with a lot more capital, or retire a lot sooner going forward. So keep your, this is the trader tip of the week. One of the trader tips this week is to just not be in the market at all times. Understanding it's not about owning stocks, it's about protecting our capital. And we're in a market condition right now where it's not about trying to make a few percentage points every week in this volatility. In fact, you should be stepping aside, let everyone else get their fix and blow up their accounts, because that's what this type of price action does, and save your money and go out and enjoy spring and do things like that. Anyways, I'm Christopher Mullen from thetechnicalinvestor.com, and that's your trader tip.